All right. Good evening, everybody. Happy Thursday. Welcome to the tail end of the week. What a day today. My goodness. Was just going swimmingly. And then the market's addiction to the Fed came into play. Oy vey. All right. Well, we'll see where it puts us. It'll be an interesting one to discuss tomorrow. But in the meantime, welcome out, everyone, to the Market Watch Group Options Foundations 2.0. Right? Steven said, I wish the Fed would keep the Indians at bay. No kidding. Well, in the meantime, what can we do? Well, if the market's going to get into I still think we have what we need for a bullishness. I think we can sustain this. The market can let its bullishness prevail. But in the meantime, are we going to need some additional strategies? Well, yeah, of course. Even if we get this bullish April, and then we hit May and June when the market's tendency is to go more sideways, what do we need? We need the ability to put on trades that benefit in sideways markets. Stocks don't benefit in sideways markets. Covered calls do. Covered calls works in a sideways market. Add that to the list, which would theoretically mean naked puts would work well as well. The problem is that both of those are Vega negative strategies. So those do work, but they work better in a high implied volatility market, when the expectation would be that, if anything, implied volatility is more likely to drop. But that's not the condition that we have. We're in a low volatility market. And right now, if anything, our expectation is that the implied volatility would rise. Therefore, what kind of a strategy would we be more inclined to put on? A Vega positive strategy, a strategy that benefits when volatility rises. That's what we're talking about today with time spreads. When we say time spreads, we don't mean necessarily that it benefits from time. Any spread can theoretically at a certain time benefit, right? We can put on debit spreads. It costs us money. It can be time positive or time negative. What we're doing here is we're literally dealing with spreads that are not of the same expiration. That's what we mean when we say time spreads. Now, we are looking to capitalize from time, but we're also looking to capitalize from volatility. So, right, when we talk about time spreads, we're talking about a specific type of spread. We've covered debit and credit spreads. Those are vertical spreads. Today, time spreads are different, and that's what we're getting into. So that was a big, long intro. Take a breath. Let's get cracking. I am Scott. I am your host. These are the disclaimers. Education and illustrative purposes only. We are not advisors. We are not brokers. We do not give recommendation nor guidance. Everything we provide is for sample and representation only. Today's agenda. Okay, let's get into it. Number one, what are time spreads? We've started talking about them already. They are combinations of options, and we'll get into this in more detail, whose expirations are different. That's the primary definition. Different levels of time spreads. What kinds do we have? We'll talk about calendar spreads. Oh, I love calendars. And anytime the implied volatility is low, expect the possibility of a trade alert for a calendar spread. That's the first thing. Okay. And now that you'll have seen this presentation, and then you'll watch us do some practical application on Tuesday, you'll be ready when those alerts come. We'll talk about the advantages and the disadvantages that calendar spreads offer. Then we're going to talk about diagonal spreads. What are they? What are the advantages and the disadvantages? How do we determine strike prices? And then we'll talk about tips for success when trading time spreads. We will talk about pitfalls to avoid when trading time spreads, and then we'll summarize it, call it a night. Let's go. Questions as they come, please. If you have a question, please ask it as it comes up. I will try to address it as it comes up, and then we will go from there. Okay, first and foremost, what are time spreads? The definition: time spreads, also known as horizontal or calendar spreads. And it's not just horizontal or calendar. Anything, I'm going to change this a little bit. Anything with different expiration dates is theoretically in the category of time spreads. But we're going to talk about horizontal or calendar spreads first. It is the simultaneous purchase and sale of options with the same strike price. This is we're talking about a calendar or a horizontal spread now. Same strike price, different expiration. Same strike, different expiration. What is the purpose? Time spreads capitalize on time decay, leveraging the rate at which options lose value over time. First and foremost. Second purpose would be to leverage implied volatility, and to some extent, even create an implied volatility hedge. What do we mean by that? Well, remember this: if implied volatility, or if the market drops, what happens to implied volatility? It spikes. It spikes up a bit. What does that do? Well, if you're in a Vega positive trade, anytime volatility rises, it pumps value into your trade. So that's essentially what you have. Is if the market were to drop, your calendar spread actually holds up better than most things, which is interesting. And at some point, you're going to see that. It holds up to the point where you have the ability to take a small loss and get out, or even try to adjust the trade and jump into something else. So we'll talk about that as we get further on. What are the types of time spreads? Calendar spreads and diagonal spreads. The importance of neutral and bullish directional time spreads. So neutral directional time spreads. Time spreads can be employed when a trader anticipates price movement in the underlying or minimal price movement. So that's what a calendar spread does. If you think the market's just going to sit, it's going to pull back, it's going to linger. These are everyone thinks, oh, iron condor, put an iron condor on. And that is true. That does work. But an iron condor is a Vega negative strategy, and it's a very rigid trade. And you realize the more you learn, the more you're like, wait, I want something that I can adjust a little better. So that's what we're thinking about here. Now, a bullish directional time spread, that's when we're building a little more bias. We can actually put a little directional bias in with calendar spreads, but we're really going to be using diagonal spreads in that type of an environment. A diagonal spread is going to give us a delta positive, we think the market's going up. A theta positive, we make money as time expires. And a vega positive, we make money if volatility were to rise. Do we expect volatility to rise if the stock goes up? No, we don't. We do not. What we expect is that it's going to stay low because it's already low. So in that situation, what we've done is we've nullified implied volatility, and we're capitalizing on delta and theta. When you're done this time around with the options class, those of you who are participating, when you're done this time, I want you to be thinking about and able to define 3 aspects of an options trade: the price, the direction; time, the theta; and vega, the volatility. What do I mean by that? Well, if you had an options trade, let's say you bought a call, I would expect that you'd be able to give me an explanation where you say, yeah, I bought a call. I'm delta positive. I think the stock's going up. Number 2, I'm theta negative. I'm losing money on time. I know that. Here's how much. And the reason I'm willing to accept it. So in this case, what you're doing is you're saying, yes, I have accepted that time is working against me. That's my pawn. I'm sacrificing time. What do I get? Well, either A, I'm going to tell you that options were cheap, things are moving quickly, and I only expect to be in the trade for 5 to 7 days. Oh, well, that makes a lot of sense. That actually will work perfectly in my favor. And that's it. That's all I would need, is just simply that you've addressed it. You didn't happen into a trade and be like, oh, wait, what's the delta? What's the theta? Every time you make an options trade, you're going to be thinking about, number 1, what's the price? What do I expect it to do? Go up, go slightly up, go sideways, slightly down, or down. I got 5 potentials. Number 2, how long? And fundamentally, are the options expensive or cheap? And if they're expensive, I'm going to do something that's more vega negative. And if they're cheap, I'm going to lean into something more vega positive. And time, right? So those are the elements that we're building into this. Let's hit it. Calendar spreads. Same strike, different expiration. Right? Same strike, different expiration. I buy I sell an at the money call. That's actually the first thing. I sell closer to the money, or excuse me, closer to expiration, the near option. And I buy the farther one. And you might think, wait, the farther one's going to be more expensive. It is. This is a debit strategy. We are doing long calendar spreads, which means they are debit. You are buying them. It is very uniquely one of the few debit strategies that produce positive time decay. And the reason why is because, remember that I'm going to draw this. I'm going to draw a little picture to help explain this so you get a sense of what we're benefiting from. So here, my mini whiteboard, I have an option that I'm selling for 2 weeks, let's say. So for the first week, it's decaying like this, and then all of a sudden it really starts to fall off. And at the same time, I buy an option. Right now, the one that I bought, I do pay more for, so it's up here, but it's going to be going slowly, 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 slowly. And then all of a sudden, then it's 2 weeks. And so if we're only in the trade here, this one lost a lot of money from time decay. This one didn't lose very much. The fact that the shorter term goes at a faster rate is decaying in my favor. That's what makes me theta positive. So that's what we're benefiting from. When we sell something that's shorter term, it's going to hit its time decay drop off at a faster rate. And that's when we're going to really start to benefit, as long as the stock doesn't move too far up or down. Now, if it does move up or down, we do have strategies to adjust these trades. We're not just sitting ducks and like, oh, I hope it comes back. We can absolutely make adjustments to these trades. And there are certain conditions when we make them. That will make a lot more sense come Tuesday when we go through this. But I want to make sure that you're comfortable with the why. What's the strategy here? Designed for stability. We capitalize on time decay, minimal dependence on price movement. When does that work? I'll tell you right now. One of the best ways to use these is in a bullish market. And when the market's at support, you're buying into bullish trades, expecting it to bounce. And when it bounces and it gets up to resistance and you start shutting trades down, what do you expect it to do? From there, you're expecting it to pull back, go sideways a little, start to go up, even if it's only for a week to 10 days. Well, that's exactly what a calendar spread benefits from. So at support, I put on bullish trades. At resistance, I put on neutral calendar trades in a leapfrog fashion. And you might say, well, what happens if the market breaks out? Does that happen? Of course it does. If it breaks out, I wait, and then I can put on another piece and start to connect the trades. Like I said, they have adaptability. They can work even when things start to move. So that's hard to explain in this environment when we're just going through it in the beginning. But it'll make more sense when we go through and build these for real. Construction, choose the underlying asset. Stocks that are stable. What's my preference? ETFs, and in particular, market-based ETFs. SPY, QQQ, IWM, DIA, some of the big XL sector stocks. Those all work. And they're stable. They have high liquidity. They're perfect for us. And we can stagger the short-term, long-term expirations to exploit the time decay differentials. My preference, I'm typically going to sell 2 to 2.5 weeks out. I'm going to buy 4 to 4.5 weeks out. These are very short term. Can you do a calendar spread that's 1 month, 2 month, or 1 month, 3 month? Absolutely, you could. And a lot of times people choose to roll them so that as they move, they'll roll. They'll buy back the option they sold and then sell another one, and they'll do that for a credit. That's a great way to go. That's not how I do it. I'm not going to say that's wrong. There's a lot of people that are successful that way. I tend to do short term. I get in. If I get in and then a week later I can get out and make 20, 25%, I'm gone. If it goes against me, I put on another trade and then wait. And then if it goes in my favor, boom, I'm still going. This is a trade that I'm expecting to be right. About 70%, possibly more. I would say over time has it better than 1-to-1, but if you plan on a 1-to-1 reward to risk, still positive expectancy, right? At 70%, that's still a 40% expectancy in the system. Beautiful. Is it just like something you can put on all the time? Literally, when the pandemic started, 2020, volatility spiked. I've shown you, spiked up to like 85. Ridiculous. And I was, doing webinars and presentations. I said, oh, it's going to be a long time. A long time. The VIX didn't break back below 15. When it broke back below 15 is when I started again. I didn't do a single calendar spread for basically 3 years. I mean, I wanted to. And could I have? Probably. But I said, I'm going to stick to a very specific market condition. And I did. Because when I traded in that condition, has a phenomenal expectancy rate. So yeah, for me, short term, 2.5 weeks for the short term, 4 to 4.5 for the long term, 2 weeks apart. Determining strikes, I'm going to be at or near the money. If you go too far out of the money one way or the other, you're going to make it more directional, and that's not the objective here. If you want to make it more directional, do a diagonal spread. That makes it more directional. That's not what we're looking for. Managing calendar spreads, we're monitoring time decay. You can roll positions. You can add to the position. And then we look to close the position before expiration. As I said, this is a trade that's not like, I'm going to squeeze as much as I can. If I put the trade on and a week later I've got 20%, I'll take it off because I could be putting a new one on. We put it on in week 1. and we can put it on and adjust it. And then into week 2, right, we can still be adjusting it all the way through. Adjusting means we just add another piece to it. The later it goes, the harder it is to adjust. And then we have to look to basically just book profits or take losses. But it should be pretty well controlled. When you say sell to open close to the money, stock at 50. Okay, sell to open 49, buy to open 60. That's a diagonal spread. That's 2 different strikes. We will talk about that here in a minute, but right now we're talking calendar spreads. So I would say 51. If I'm at 50 and I'm in a mostly bullish market, I'm going to tend to err a little on the side of bullish. So 51, 52, a little above it. And so we're going to sell to open the 51. So right now, 2.5 weeks out, it's a Thursday. I would be selling the April 19, and I would be buying the May 3rd, and the strike price in your scenario would be a 51. Stocks at 50, I'd go 51, a little out of the money above it. Because I am still bullish right now, regardless of what the market did today. I'm still bullish. That didn't change me, right? So calendar spreads, the strike price is the same. It's the expiration that differs. So we're selling 2 weeks out expiration. We're buying 4 weeks out expiration, 2 weeks and change. Okay. Bam. Advantages, low cost. They don't cost a lot. It is a debit. So your risk is limited to the debit that you pay, but you should be planning to lose like no more than 30 to 50% of that debit, to be perfectly fair. Maybe even less than that. Maybe even less than that. The risk is capped, right? And like I said, it's confined to the initial cost of establishing the spread. What are the disadvantages? This is not a home run. You have a limited profit potential. You can actually do quite well. We put one on that after a couple of weeks made 85% the last time we did this strategy, right? We did it and we made 85%. I mean, it was a great trade. So they can do very well. That's not the expectation, right? Normally, by the time you're hitting, there's times where it gets to a point and I'm like, all right, if it moves, I'm out. And then it doesn't. And then it doesn't. And then it doesn't. And then all of a sudden I'm like, oh my gosh, look at that. And bam, you take your money because time is working for you. So in situations when directional trades, think how many times you're in a directional trade and nothing's happening. And you're just a little bit anxious. And you're like, oh, imagine if you had a trade that was doing perfectly during that time. So in this regard, the way that I look at it is diversification by strategy. I have directional trades that if the market takes off, bam, I'm ready to go. I've got the puzzle pieces in place. But if the market stalls, all your directional trades are going to be iffy. If you have covered calls, you'll do okay. It'll be all right. If you do some spreads, you should be okay. This is how you're actively taking advantage of a sideways market. And what is the likelihood of a sideways market, particularly coming into May, June, July, August? Quite high. What are the disadvantages? We talked about this. Sensitivity to implied volatility. If you get it wrong, and implied volatility drops hard. And I've done this where I was like, and that's one of the reasons I didn't do it. When we had implied volatility, it was like 18. And I put it on, and all of a sudden the market just smashed higher, and the volatility dropped to 12, and that it just was too much. Even being able to put on a new calendar at a much better area, that first trade went underwater so much you couldn't recover, and I had to just take the loss. And so that's a risk. It is very sensitive to changes in implied volatility. You'll have a very small delta. We call it delta neutral, very small delta. You'll have a pretty decent positive theta, and then your vega is going to be the biggest component by far, which means that if volatility rises, you're hedged, but if it drops, you're a bit in trouble. So yeah, we want to make sure that we don't put these on in the wrong implied volatility environment. Okay, let's pause. I'm going to build it. I'm just a real quick look at it. Just a real quick look. We're going to practice, and we're probably going to do more calendars than diagonals, just so you know. So right now, let's take a look at this market. Oh, our poor market today was looking so strong in so many places. And it just sort of fell apart on us. Certainly gonna throw a wrench in the works. A nasty engulfing pattern there. We definitely had increased volume. However, we're still above the 50. I'm actually okay down to this level here. I would say 505. From 524 of the high to 505, that's 20 points. That's 4%. 4%. Remember that a correction is 10. So let's not get like, oh, yeah, the market got jittery. We know that there's been a little bit of hypersensitivity to the Fed. But we're okay. We're okay. What else did that do? Well, it did spike the implied volatility. I'm wondering, did anyone get some hedges on? Just as we talked, we said it's not a hedge signal, but that, of course, anytime you're carrying more bullish trades and the VIX is at 13 and concerning, never a bad idea to put a hedge on. That signal came back here, if you remember. So it would be ahead of the game still. Let me know if you have any piece of that. Okay, so let's just assume it wasn't there. Let's say the volatility was back here, still around 13 or so, right? Now, if I did have a calendar here, I'd be a little underwater at this point from the stock going down, but the volatility going up is helping me, and I can actually put another trade on to sustain and create like a broader range. It's very cool stuff. In this case, with the volatility spiking, I would actually be more inclined to add a butterfly spread. That is a week from today. We will be talking butterflies. I would be adding a butterfly spread to the calendar, and they work in conjunction. They're like cousins. They're like cousins. One's Vega positive, one's Vega negative. But other than that, they get along well. They play well together. Okay, so let's just real quickly take a look at this thing. Let's take a look at a calendar. No questions. You guys, I know you're all quite smart. So I'm not surprised that you're picking up on this, but I'm just want to make sure that you are indeed picking up on this. April 19 by May 3rd is what I'm just going to play with for a minute. So I'm going to go, not here, not there, not there. April 19. I'll adjust the May 3rd later. All I need to do is start with April 19. I do puts. You can do either side, right? If I go, let's say, just slightly out of the money on this one, let's say we went to 517s, okay? You can see it's cheaper over here than this one, but they'll fundamentally behave very similarly. So I'm doing a put. So when I click on this ask price, because it's a debit, there's a calendar right there. That's a calendar spread. You're buying April 26. I said 517. Oh, I was just looking at them. It's just slightly out of the money. We're at 513. I went 2 strikes out of the money. I think I was looking at 517, but yeah, I mean, it doesn't, they're fundamentally not going to be too different. 517 will be a little more bullish, a little bit more bullish, a little more delta. So if you're like, oh, I think we're going to have a bounce, maybe you would go with the 517. So, but what am I going to do? I'm going to sell the April 19, but remember we said buy the May 3rd. So I need to take this and extend it out to May 3rd. Okay. And you can see that puts a bigger debit on my trade, but let's just kind of watch so you can see the implications. Delta's 20. It's not very big. Why we call it delta neutral, but it's It is above. Now, if I change this to 513, watch what happens to that delta. It goes to 6, right? It goes to 6 because it's closer. Now, if I go below it, if I go down to 511, it's still going to be a small number, but now it's a -6. Now I want it to go up a little bit, right? So that's what we're doing there. So let's go back to 515. Now, what else can I look at? Well, look at my theta, $61 a day in time. Remember, we changed this from April 26th. So April 26th cost less, only cost 86 cents. And I'm getting $40 a day. And here I go to May 3rd and it's now $1.70 and I'm getting 60 a day. I got to tell you, I'm actually thinking I'm going to leave it. Why? Because I'm paying twice as much, but I'm only getting 50% more theta. Vega is 160. And if we go back here, Vega, so we get less Vega, but we get a better bang for our buck on theta. So if time decay is what we're looking for, I'm actually going to leave this like this. I kind of like this. I like that I'm getting that better theta. Now, remember, we're likely to hold this for maybe 7 to 10 days-ish. So if I go here from 4.4 to 4.11, it goes from 40 to 73. And this one goes from 70 to 104. So not only do I like the first one, but I like that it increases at a faster rate. So yeah, you know what? Convinced. I'm not married to any. Once I'm mathematically can see that one way is better than another, I'm gonna go for it, right? And so what does this look like as a risk profile? Looks like this. Okay, let's bring this up. Now let's bring this back to today. Where are we right now? Right here. How does this trade make money? How does this trade make money? Well, you can see that if it goes up or down, it's not really benefiting me. I'm just moving left or right on this purple line between here and here. There's not much. So anywhere between 506 and 525 just kind of sits there. I'm not making money as it moves up and down. What am I making money from then? I'm making money here from theta, $40 a day. I make money here from Vega if time always ticks. We don't have to worry about that. I only make money from Vega if implied volatility rises. So let me show you how that works. Here's implied volatility rising. Now you'll notice two things are happening. Number one, this curvature line is showing me my profit from day to day. That's getting better. But number two, the profit potential. What you think your profit is actually getting better. So watch as I continue. If the volatility goes up by 3%, you can see it's significantly different now. My range is now from 503 to 528. My potential is higher and I'm already making money. Already making money. So that's how volatility impacts this, which means if you get it wrong and this thing drops 1%, look at it shrinking. You're moving into loss and its overall potential is shrinking. Worse and worse. If you get on the wrong side of 4%, that's why I said to you, it was irrecoverable. I had to just close it down. We cannot get the volatility wrong. Let's go back to 0 because look at your variables right here. Delta 0.65, nothing. Theta 40, Vega 86. What are you most sensitive to? Implied volatility, changes in implied volatility. That's why it has to be a low volatility strategy. That's why I was so adamant that the VIX was back below 15, right? Now, what happens if this thing all of a sudden makes a bashing move up to 527? 526. At 526, I'm only losing $100. And what can I do? I can put another one on up at 530, right? So I can analyze this thing up at 530, and it's gonna probably now let's probably say it's hard to know for sure, but we'll say something like that. Yeah, I can extend this trade. So now look, now I'm good from over here at 511, not down at 505. It's at 511, but that's okay because I'm way over here at 526. And now I'm good all the way to 536. So as long as this thing keeps ticking in time, boom, I make money. I make money from time. Time is the biggest lever of change for me in that regard. So ideally, what happens, we stay here in the middle, and a week later, we get to a week later right here, and you can see if I have 10 contracts and I've made $500, that's 50 cents a contract. Like on a trade like this right here, I only need to make, that's 860 in. I only need to make $170. If I just had 170, a week later, I could walk away because what would I do? I could put a new one on as long as the volatility was low. So low volatility with the goal of it increasing. Well, no, Sandy, because remember, implied volatility increases typically when the market drops hard. Low volatility with a goal of it staying low. But if the market does crater and drop hard, where you think you might lose money. So let's go back to the original example here. Kind of feel like I'm not going to get to diagonal spreads tonight, and that's okay. I might have to I think we have extra days. So I might do calendar working session, diagonal working session. We'll see. But I think we're in a good place trying to get this figured out. So let's go back to today. We're starting right here. Now, you look at this and you're thinking to yourself, if this thing drops to, let's say 505 and a half, let's say 504, you think if it drops to 504, I'm in trouble, right? Let's put this down here. 504 drops down to 504 from where it is now. You're going to be losing $235, or so it seems, right? But that's a 513 down to 504. That's what, 9 points? Today we dropped 6. So we dropped 6 and the VIX went up 2. So let's say we went up 3 points if the market dropped down here. Okay, so what am I going to do? I'm going to play with this implied volatility a little bit. And I'm going to say, what is it going to, remember, we thought we were going to lose, we thought we'd be underwater $250. But if this stock, if the SPY drops down to 504 and we get a 3% bump, we're actually breaking even. And now, if I think, oh, it's going to stabilize, and this is going to answer your question, Stephen. He says, when you extended, did it basically add the two together? Yeah, the model is going to look at the two in combination. And we're trading them in combination. But I could build another trade over here, whether it's a butterfly or a calendar, and all of a sudden, when they connect, you can see I have this great vast range where the market stays in this range, which it's very likely to do. I make money from time decay. Time. That's what this is about. Time. Get on the right side of volatility. Put time in your favor. It's not like we're going to stop directionally trade. I love directionally trading. I'm always going to directionally trade. Always. That's why we posture the market, to recognize when we have conditions that are more conducive. But look at right now. We have conditions that are more conducive. Does that mean the market's just easy and you just throw spaghetti at the wall and trades make money? No, there's going to be times where it goes through little hiccups. Okay, we'll sustain it. But if we start to integrate more of strategies like these, the hiccups are just part of the process. Questions, or is it making sense? Is it clicking? Okay, so back to this original trade. We're going to no. Put and calls. Great question. Put and calls. I'm going to change this. So I want you to watch your delta, right? It's around 11. Theta 40. Vega 86. Okay, just remember that. Well, you don't have to remember because I marked it. Now, I just changed it to calls. Okay. This is puts, same strikes, same everything. Calls and puts. Doesn't matter. But you can see. Now, in this one, I'm a little more delta positive. Well, let's there. A little more delta positive. I am a little less theta positive, but barely. And I'm a little more, I'm about the same for Vegas. So you can see they behave, even though they cost different. Now, this one costs more too. So in that regard, I'm like, well, I may as well put less into the trade, right? I may as well put less into the trade. So no, I do puts because they give me just a very slight, I want more theta if I can, and I want a cheaper trade if I can. And I got both of those accomplished this way. What percent IV? Honestly, you want this in the lower, like 15 percentile, 20 percentile of IVV index. I mean, really, I look at the VIX and I want the VIX under 15. If the VIX is under 15, I'll consider it. If the VIX is at 12, it's almost automatic that I'm trading. I've been trading these all year long. I've done a couple with us as a group, but yeah, these are, phenomenal. I love them. They're very complimentary, right? But I've had years where I made more money on calendar spreads than anything else. Yeah. So this looks pretty good, actually. I'm probably going to put this on and just, well, I don't know. I'm not going to. Let's take that back because there is a little bit of a volatility concern. I don't love that the volatility is at 17. That's yeah. If we were under 15, yes. At 17, it's a little more concerning. But this is what the trade looks like. This is a calendar spread. You would slap it on and then what? Nothing. Watch. As long as it doesn't move up here. This is 1%, 2%, at 2.5%. As long as it doesn't drop more than 2%. And even if it drops 2%, you can extend it. But if it just sort of drops a little, then starts to pop again, a week later, you're done. That's it. A week later. Boom. Now, if a week later you're sitting here, now let's say it's a week later like now, because that's Friday. And you're saying to yourself, you know what? As long as it doesn't get below 512 or above 516, I should hold it. Why should you hold it? Because if you get past Friday, you get, let's just watch this middle number. This will be interesting. Okay. Watch this middle number, 412. Saturday, I'm at 497. Sunday, I'm at 596. And by the time we get back here on Monday, I'm at 713. So if I'm at Friday, what am I going to do? I'm going to be like, you know what? Unless this thing is showing real signs of dropping or rallying, let's hold it till Monday and see what happens. And if you hold it till Monday, and let's say on Monday it goes up here to 515, I'm going to set a range. I'm going to say, all right, as long as it stays between 512 and 518, I'm going to give it one more day. And then boom, you give it one more day. 738 becomes 886. Why? Because we're getting so much closer to expiration. And then if I give it one more day still, we're at $1,000. Done. I'm done. Call it. $1,000 on this trade. That's over 100% return on what you paid for it. The cost is $86 per contract to start this trade. 86 a contract. So remember, we said the advantage is it's low cost, not a lot of risk. It's not this like, oh, is it going right or wrong? We put it on. If it works, we stay with it. If it doesn't, we adjust it. If it doesn't, we get out. I've actually had times that I've adjusted 3 times and it still worked. It's a trade that and again, we're not trying to push. We can automate it. So like I said at the end, if we get to a point, you can put a conditional trade on from here to here. And you can say, if it breaks this, I'm out. If it breaks this, I'm out. And you can leave it on until it gets, and if it just sits in this range, eventually you get to a point, you get out and you're done. I'm telling you, it's magic. It's magic. I had a period of time, I think it was 2019 or 2017. I had like 14 weeks in a row. Just boom, put it on, next week, take it off. Put it on, next week, take it off. Put it on, make an adjustment, the next week, take it off. Well, meanwhile, I mean, it's just one week after another after. It was amazing. It was just this amazing run. I was just like, oh my gosh. So it's worth learning. The person I learned this from actually was one of the founders of Thinkorswim. So Dan Sheridan was his name, but really interesting. I never had a good way. When I first learned about calendars, I'm like, what is this even going to do for me? It's, but when you set it up and you play with it a little bit, you can build these structures. It's amazing. Generally, we have seen the VIX go up and then track back down. It has been this same pattern in the past 5 weeks. Does it really matter if we get in at the VIX at 17 when we expect it to go down? Well, do we expect it to go down? And also remember that if you expect it to go down, the volatility is going to hurt you if it goes down, right? Remember that if the VIX goes back down, that's antithetical to the Vega. So the VIX going down is hurting you at $86 for every 1% the VIX drops. So if the VIX drops 3, you lose 230 from this. That's going to put you at a negative situation. So, I do prefer a VIX sub 15 for me. Sandy says she loves its calendar spreads, right? I mean, they're really, when we can get them in the right conditions at the right time and really build a good structure around it, they could make the difference this summer for a sideways summer if we have that. Now, are we going to get bearish because the Fed is stalling? No, I don't think so. That's not a bearish motivator. That's a like doldrum indicator, right? So if that's the case and the vol stays between 12 and 18, we'll do well with mostly calendars and a few butterflies. And we will learn butterflies, but the schedule may shift a little bit. I actually needed one more week of content. So I think what I'm going to do is just, we'll still do application on calendar spreads next week. And then I think I'll just do like a separation, and we'll do diagonal separate. And then we'll do yeah, I think that'll work. I think I have time for that. I hope. We'll see what happens. We'll figure it out. We'll play it by ear. Okay, let's go back to the slides. So diagonals, we're going to hold off on. Tips for success. Yeah, like always, monitor news, economic indicators, track positions real time. Start these in low volatility. That's your number one tip for success. Start the trade in a low implied volatility environment. So market, yeah, buyers come back most every time the Fed has negative. I agree. I'm still bullish, Stephen. 100%. I agree with you. So, diversify across strategies. That's what we're doing here. We're not diversifying across. We diversify sectors, right? We don't like to overweight in sectors, but we diversify by strategy, so that if we buy too many options, you're going to see that your negative theta is ramping up. And what do you need to do? You need positive theta. How do you get positive theta? You start doing some spreads, and now you've diversified by strategy in order to control time. You might also have volatility issues, and you might diversify by strategy for volatility. And that's a big part of what this strategy can do. So, yeah, adapt to changes, without a doubt. Adapt to changes. Some pitfalls to avoid, something to be thinking about. Make sure you understand time decay. Remember that in this case, it's helping us. And you actually saw that we made the decision to do a 1 week time spread instead of a 2 week time spread between the expirations, because we didn't want to double our cost, but only get 50% more theta. Easy decision. That's a business decision. Ignoring market trends and diagonal spreads. We'll talk about diagonal spreads later. We want to be adaptive. Anytime you put a trade on, you've got to know, what will I do if it goes up wrong up? What am I going to do if it goes wrong down? If it goes wrong up, you'll probably add another calendar spread. If it goes wrong down, maybe a calendar, but more likely a butterfly. If it keeps going the other way, then we got ourselves a little bit more trouble, but we may still have a third adjustment with these. We're not gonna quit early or easy. We'll keep trying. When I do these as alerts, we will follow, and the alert will include adjustments, and then it will include automated orders. That's the only trade I will do that with. Everyone else is on their own directionally. But when we do the calendar spreads, it's hard to get the subtleties of that. It took kind of a while to get it, and so I will make sure that I'm going to provide some updates to those strategies. Okay. Yeah, we have to be ready to adapt. We have to be ready to close. If we don't do that, the strategy can get away from us. Okay, calendar spreads, neutral strategy, time decay. Make sure that we're constantly getting better at this. Sandy's loving it. This is art. It is art. It is art and science with a little bit of psychology, a sprinkle of luck, and a dab of superstition. That's my recipe. What are your questions? Do you have questions? This appears you are providing some entrance and exit criteria. Well, okay. So entrance and exit criteria here is a lot easier. Essentially, it's basically, you're not, this isn't directional. So your thought process, when it gets to resistance, you're done. You start. Remember that when you get to resistance, that means the market's at its highest point. When the market's at its highest point, where's the volatility? At its lowest point. Bam. We put it on with the expectation, right? So if you think about what an entry criteria looks like, market's going, let's say this is the SPY, and it gets up to here. What are you thinking? Well, any bullish trades you put here, you're probably sold some there. You're tightening stops, getting ready to sell some here. And as this thing hits, calendar spread. Now, what do we expect? We expect this. It's going to come down, but not too far. And then when it passes back through this point, 10 days later, that calendar spread is like, bingo, it's profit. And so you'll probably be putting on more bullish trades here. And as you shut this down, you're ready to put the next one on. And the next one you put on, and then it breaks out. You're like, oh my gosh, what do I do? Well, I wait until it settles again, and then I put a second one on. Now I have a double calendar. And as long as it then makes a reversion of some kind, boom, within a week and a half, the whole thing makes money. They work out great, even in a trending market. They work out phenomenally well. And then when you have times where the market grinds, that's when these things, where the market grinds and you're really stressing on your directional trades, these things can just be like pop, 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 pop. Every day a little better. You're just like, if it doesn't move, it doesn't move. The next day, if it doesn't move, okay. And then you're like, hey, it's the end of the week. Let's give it the weekend. All of a sudden, Monday, Tuesday, you shut her down. And it's like I said, at 20-25%, this trade's a good trade. But those times when it really gets stalled out in a rut and you have these on, you're getting 60, 70, 80%. And that makes all the difference, because when we're wrong, we're still only losing, like I said, maybe 30 to 50% of the original, ideally closer to 30 as an average, maybe a little worse than that, but that's the thought process. Calendar spreads. Here's the thing. It is very difficult to understand these trades if you haven't put all your building blocks in place first. You got to start with terminology and definitions. And you got to talk about being a buyer. Make sure you really understand that. Then you talk about being a seller. Then you talk about adding a combination. And now you're doing debits and credits. And then all of a sudden you're like, well, now wait a second. What if we do? And it's just, it's opening this world of possibilities that options provide. But it takes it's a diligent process to get there, right? You don't just like, sleep on the book and osmosis, you know what you're talking about. So I applaud you, those of you who are here, everyone who came and stayed the whole time. It's amazing. This will change how you trade options. I promise that. Right? I mean, you don't hear me get into it a lot. And I still can't get into it too much, but the more times we've had the foundations and we've talked about it, the more times I am going to talk about it and force people to go watch the video, because if you're going to trade options, this complements your trading in such an amazing way for very specific market conditions. So anyway, there it is. Calendar spreads. Amazing. So good to see you guys. Stephen wrapping things up with a compliment, and I love that. He said they're the most interesting to listen to over and over. That's great, because sometimes I think to myself, are they listening to it the way I listen to ocean sounds to just kind of put me to sleep? I don't know. Where can I find an options dictionary? Oh, there is. That's a great question. Yes, what a great question. And we still need the April 1st video. Yes, I will post that. An options dictionary. I mean, if you even just like are I'll tell you, here's a piece of advice. Chat GPT. If you go to Chat GPT and you say, what is this? And how would I use it about an option? You will get an amazing answer. How about that? I'm gonna stick with that, but I am gonna put together, that's a great call out, to maybe put together a little sheet with some option resources, a few books, a few websites. There's some sites like CBOE and OCC that have like free basic education and things that you can just go pop into for additional, like there's some good, Sandy said most platforms have a glossary of terms. Let me put together something, but how about, I want you to start with, I want you to start with the play with it. Play with ChatGPT. I think you'll enjoy it. Anything else before we wrap it up? Yeah, I keep forgetting to tell you that, but ChatGPT, when you're like crafting trading plans, trading rules, just any kind of technical writing, and you're like, help me write this. It will really kind of help succinctly define some things for you. So pretty good YouTube videos. There you go. All right, you guys. Tomorrow is afternoon coffee and market chat. So I will see you at 3:15 p.m. Eastern time. Have a great night. Be careful out there. And as always, happy trading.